Have you ever stopped to think about how inflation can impact your retirement? I would say that for most of us, we haven't done too much thinking about that until 2022 came along. And then inflation got very much out of hand, very high from a historical perspective. And we started seeing the prices go up at the grocery store, at everywhere you went to. Essentially, gas is also prices just got really wild at that point. And that's when inflation became something that people started thinking about a lot more. Now it's come down a little bit as of filming this video. We're in early 2023 is when I'm filming this, but 2022 was a year of high inflation. So I want to talk a little bit about that today because it can have a big impact on your retirement if you don't plan properly for that. If you're new here to the channel or to the podcast, if you're listening to it, my name is Chris Hammond, financial advisor at Hammond Wealth Advisory, and we help out our clients with preparing for retirement and even once they are retired, making sure that they're doing the right things, managing their money the right way, doing the long-term tax minimizing strategies, things to help them to preserve their money throughout the rest of their retirement so that they don't have to worry about, am I going to run out of money in my later years at my most vulnerable times when Social Security is all I would have left at that point. Right? That's the goal, right? So one of the big things that can impact the ability of your portfolio to go that distance and to last throughout your whole retirement can be inflation, because inflation is going to impact the expenses that you pay. So let's go through this a little bit today, and let's talk about first just setting out what the definition of inflation is. We're going to define inflation for our purposes today as the rising cost of a good or service over time. That's how we'll do that. We know prices go up over time, but it's one of those things where it's kind of hard to wrap our minds around it because it just kind of subtly happens, almost like you can't tell that your children get older until you look at a picture of them from 3 years ago and then you see it, but you didn't notice the change as it happened. That's kind of how inflation works. Now, it's important to understand this because this can impact your cash flow in retirement. And that's really important because that's what you're going to use to pay all the bills just to maintain your standard of living. That's what you're going to use to pay to go on vacations. That's what you're going to use your cash to give gifts to the grandkids, things like that. Well, it impacts your cash flow in a big way when expenses go up. It can even impact taxes as well. That's right. If you have money in a 401k account that's never been taxed before and expenses start going up, then what you have to do is you may have to pull more money from that 401k to cover higher expenses, especially if you're in a situation where Social Security does not cover all of your expenses. And you're going to get the cost of living adjustment with an increased Social Security check. But if it's not enough to cover it and you already have this gap in place of Social Security is down here, but my expenses are up here and it's not covering it, well, that gap's only going to get bigger as inflation goes on over time and prices go up more and more, which means you might have to draw more from that 401k, which is going to impact the taxes that you have to pay because those withdrawals are taxable. And it's ultimately going to impact your money's ability to last the rest of your life. All right. That's probably one of the biggest fears that people have is that I'm going to retire. Perhaps without the proper planning, they're not going to know. They're going to worry that they retired at the wrong time. They didn't save enough. Maybe they don't have an idea if they have or not. They're just kind of blindly going into it. And one of the biggest fears they have is that, oh no, now we're 15 years down the road. I'm having to pull way more from my portfolio just to make ends meet. And I'm worried that I'm going to run out of money and just have Social Security only to live on. Well, inflation can impact that in a very big way. Now, let's talk a little bit about how inflation is measured. It's measured through CPI, or known as the Consumer Price Index. And there's a couple of different CPIs out there. There's CPI-W. That is the one that's used for Social Security cost of living adjustments. Right there. So, most people on Social Security are going to be older, and their cost of living adjustments are going to be based on what the CPI-W reading is. But the CPI-E, that would be another CPI index that's been created that's kind of more for older people. It's not the one they use for Social Security cost of living adjustments, but it's one that they created to say, like, well, what are older people more spending their wealth on? And it puts a heavier weighting on healthcare expenditures, because we all know as we get older, we're going to spend more for healthcare than we do at a younger age. So that's why they created this other index. And what we've found is that the CPIE, the actual rising cost for people that are older, is usually a little bit bigger than what the CPIW registers and what people get on their Social Security check to keep up with the inflation. Well, what that means for you is that ultimately there's a good chance that your cost of living adjustments with Social Security are probably not going to be enough to keep up with the rising cost that you're actually experiencing. And I think if you talk to most people that are drawing Social Security, they'd probably tell you the same thing, you know. Now, cost over time, just kind of some quick examples to look at how things go up. You know, it's hard to see, like I was saying earlier, inflation in action on a short-term basis. But then when we kind of step back and we look at it over a decade-long period, we can see that prices really do increase over time. Now, if you're listening to this on the podcast, you can't see the illustration I've got here in front on the screen, but we're essentially going back from 1964, looking at prices of a gallon of milk, bread, new car, new home, average income, all the way up to 2021. Just think about average income in 64, about $6,000 a year. In 2021, $67,000. That's a big increase. If you look at over just a 2-decade period, maybe from 64 to 1984, so the average income of 6,000 went to 12,866. All right, it's roughly a doubling within a 20-year time span. Think of a new home going from 30,000 in 64 to 1984 being 110,000. So that's more than a doubling. So, you know, we step back a little bit, we can kind of see what's going on with inflation a lot better than when we just look at it year to year. And that's why it's really, I mean, that's kind of the silver lining of when inflation got so bad in 2022, is it shined a light on this so that we can start talking about this a little bit more. Now, historically, these are just kind of historical inflation rates, and you can see the big uptick in 2022 when it got very high, you know, around 8%. 2021 was also more of an uptick, but still shy of 5%. But you can see since 2010, historically, it's been kind of low. You know, inflation, it averaged about roughly 2%. You know, during that time. So we've been used to really low inflation rates for a while. And even now, inflation, the rate of increase of the inflation is starting to go back down now. So it's starting to get under control. But what this shows is that when you're putting together your retirement plan, it really is in your best interest to factor in that prices are going to go up in the future, and you have to be able to plan for that accordingly when you're trying to determine, have I saved enough to retire? Now, another way you can think about inflation and what it does to you in retirement, I just call this like the treading water chart. So if you're needing to spend about $5,000 a month today and inflation is at 3%, then 10 years from now, you're going to be needing to spend about $7,000 a month, roughly, just to break even, just to maintain the same lifestyle, eat the same groceries, go on the same vacations, that kind of stuff. You're going to need about $7,000 a month for that. And 20 years from today, you're going to need, you know, I'm just ballparking, that looks like it's around roughly 9,000 something on this chart right here. And in 30 years, you can see how it's approaching up to almost over 12,000 at that point. So just kind of think about the dollars that you're spending today. It's going to take more of those just to tread water, right? Not even to like up your standard of living, just to do that. Now, let's talk a little bit about what can be done about this. So one of the things that is really handy is for us to look back historically and see which asset classes have outperformed historically. And while there's no guarantee that that's going to happen in the future, it gives us a good idea of saying, like, well, what's probably a good idea of what would possibly outperform inflation and taxes going forward in the future. Now, this chart here, Ibbitson's is just looking at stocks, bonds, bills, and inflation going all the way back from 1926 all the way up to 2020 and showing, and you can see in the chart, if you listen to it on the podcast, I'll just describe it to you. Stocks outperform and beat taxes and inflation by about 5.3 compound annual return, about 5.3%. And that helped investors to beat inflation so that they didn't, like, 20 years down the road say, the money I had at the bank used to be worth something when I retired and I put it in a CD and now it's not worth near as much. This helps people historically, that's helped people to avoid that. And so, and while we can't say that's going to happen for sure in the future, it gives us a good idea of saying, like, well, that's probably a good option to consider as you're looking forward. Now, another thing also, and it's the reason why I like this chart, is that it's showing taxes as well with inflation. So think about this. If you have an investment and let's say inflation is 3% and you have an investment and it grows at 3%, it looks like, well, I kept pace with inflation. You did. But that growth, if it's not in like a Roth IRA or something, you're going to have to pay tax on that growth. And when you pay the tax on it, that 3% growth you had is probably going to be less than that. So you're really not keeping up with inflation if that's the case. So you kind of have to keep pace with both of these as you go throughout your retirement. So one thing that can be done is that looking at investments, things that do keep pace with it going forward and invest accordingly. One of the big mistakes that people oftentimes make is being too safe with their investments. If you just put all the money in a savings account, it's not going to lose any money when the next stock crash happens. But every year that inflation keeps working what it does, every year that it happens, even if it's not high inflation like 8% like we had in 2022, even if it's just the standard 2 or 3%, it's probably greater than what you're earning in that savings account. And it's almost a way of guaranteeing that you're going to go broke slowly over time is what's happening, because you're losing value. You might put $100,000 in there and it might always be $100,000, but that $100,000 10 years from now is not really going to be worth what it was today. All right. So you got to think about that as well. So let's just talk a little bit about some of the choices you have on how to keep up with inflation and kind of offset the impact that it has on your retirement. Investing long-term in more growth-oriented investments with the goal to beat inflation. That's one way to do that. Now, emphasis on invest long-term, because the markets do a lot of stuff, a lot of crazy stuff in the short term. And so nobody can predict what it's going to do in the short term. But if you're investing long-term with your assets that are going to be there to be there for you 15, 20 years from now, then the stock market becomes a lot less risky over the longer your time horizon that you're using on that. And if you invest too conservatively, it's almost like you're certain that your life savings, whether you spend them or not, they're depleting in value over time. The longer inflation does what it's going to do, and we're probably going to continue having inflation. There's no reason why we shouldn't. With how things are with the Federal Reserve, and that's just how our economy works. So when you're looking at what is the least risky thing for you to do, is it less risky for you to keep your money in something that takes no market risk and it will never go down when the market goes down? It won't do that, and there's a level of security there. Or is that more risky to say you're kind of guaranteeing that over time it's going to lose value? Now, when it comes to somebody who's in retirement or even approaching retirement, you kind of have to walk the line between these two worlds. You want that long-term growth, but you're probably also going to need something that doesn't act as volatile in the short term, because a lot of retirees have to pull money off of their portfolio, maybe even on a monthly basis, to supplement what Social Security is insufficient to cover on your monthly expenses. And so that's why a lot of times when people will say that when you retire, it's a whole new phase of life as far as how you manage your investments and all that. There's a lot of truth to that. So you kind of have to walk this line of saying, like, I have to have some growth oriented assets to be there to grow for me, to be worth something for the me that's going to be around 15 and 20 years from now. But I also have to have some assets that I can access now that aren't subject to all that market volatility. So I'm not having to sell them when the market's down 20% and I'm selling at a 20% loss, for example. Okay, so that's some things to keep in mind with that. So if you are concerned about retirement in or inflation for your retirement, that's understandable. You know, if you retire at 65, I mean, people live to 85 easy and beyond. That's a 20-year period. It can have a big impact. So inflation is one of those things you really have to think about. If you're looking for additional help on planning for your retirement, feel free to head on over there to my website, retirementplanningmadeeasy.com. Download a copy free of the Essential Step-by-Step Retirement Guide. And it's actually going to go through and show you where you can fill in the blanks, put your own numbers in there of going through a cash flow of your income and your expenses and things like that that are coming in. It's going to give you a good idea of what things could look like on a monthly basis for you in retirement. Very important to do that. And especially very appropriate as we're talking about inflation, because inflation affects your monthly spending over time to a huge degree. And maybe you're in a situation where you're like, you've been searching YouTube, listening to podcasts, and you're at a point where you're thinking, I'm considering possible outside help for helping to make sure I'm doing the right things to keep up with inflation in retirement, make sure I'm investing properly, making sure that I'm putting a strategy in place to help minimize taxes long term. Well, if that's the situation that you're in, when you download this free copy of the retirement guide, when I email it to you, I'll put a link in there where if you want to hop on a 15-minute call on my calendar with me, we can go over some of your situation. If there's a way that I can help you out, or I feel like our services would be a match for what you're going through, then I'll let you know about that and let you decide what you think might be best for you. And sometimes we can't help everybody. You know, sometimes people have needs that are just not in our niche. I mean, if that's the case, I'll let you know and I'll help point you in the right direction to help you out with that. Well, that's all I got for today. Thanks for taking time to watch this, for investing in your knowledge and trying to, you know, get better ready for retirement and all that good stuff. And I will see you guys on the next video. Thanks.